Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully.
Well, you're right, because historically during a recession, they cut by 500 basis points. So, if you're right that there's going to be a recession.
I think there, let's put it this way, given the quantity theory of money and what Greenwood and I think lies ahead, the storm that lies ahead, the Fed is sleepwalking into a tornado. And when they hit that thing, they'll hit the panic button. And for them, what's the panic button? Well, one panic button is the Fed funds because they watch the interest rate. The other thing is that they will terminate quantitative tightening pretty fast.
What would you say to Jerome Powell right now if he were in your class?
The end of the semester is approaching, Chairman Powell, and I'm really saddened to inform you that your grade is going to be below the waterline.
The latest headline inflation numbers came in at 3.1% this week, down from last month's 3.2%. And meanwhile, the Federal Reserve has kept rates unchanged, but has signaled that it may cut rates next year. What does this mean for the economy? Where is the economy headed? And why has the Argentinian peso devalued following the victory of Javier Milei, who wants to dollarize the Argentinian economy? Well, joining us to discuss these topics is an expert on inflation, monetary policy, and dollarization across the world. He is Steve Hanke, professor of applied economics at Johns Hopkins University. First, a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Always good to see you, Professor. Welcome back.
Good to see you too, David.
We'll start with the U.S. economy. You and I spoke last time, just days before the Argentinian election, in which we were talking about Javier Milei, and he eventually did win. So we'll talk about what's been going on since about a month ago, why the peso has devalued the way that it has, and what's next. First, let's talk about inflation. So 3.1% headline CPI, in line with your expectations. Is it not for this year?
Yes. John Greenwood and I, using the quantity theory of money, focusing on changes in the money supply, had a forecast that it would be between 2 and 5% by the end of this year. It's 3.1. We got a month to go. It's clear we're going to hit the bullseye again. Remember, we hit the bullseye going up. We made a forecast that inflation, after the huge surge in the money supply, when it went up in 2020, 2021, it peaked out at a little over 27% on a year-over-year basis. And we said that inflation would reach 9%. Well, it reached 9.1% in June of 2022. So we hit the bullseye going up. It looks like we're going to hit the bullseye going down. And we had earlier this week, John and I wrote a piece in National Review in which we indicated that given the huge contraction in the money supply in the United States, that next year, by the end of the year, inflation will be below the Fed's inflation target of 2%. And if the Fed continues on this monetary squeeze that they're on, and they continue to ignore what's going on in the money supply, that we'll probably have outright deflation in 2025. And by the way, the squeeze, what we did, the contraction in the money supply is really rather remarkable. Since March of 2022, the money supply measured by M2 has actually contracted by 4.5%. Now, there are only 4 episodes in US history in which the money supply is actually contracted. And you got to go way back to 1948-49. There was a contraction of 1.4%. Then in 37-38, there was actually a contraction of 2.6%. Of course, the big one, 29-33, it contracted by 38.8%. And 2021, it contracted by 9%. Now, what's interesting are the current contraction of 4.5% isn't over yet. It's still contracting. So that's still ongoing. And you go way back to these 4 other episodes prior in which we had contractions. And what do you end up with? Every one of them, you end up with either a Great Depression or a big recession. So next year, we're going to have a recession baked in the cake. We already know that, because what happens with economic activity is actually driven by what has happened with the money supply about 1.5 years or 2 years prior. So next year, recession, inflation coming in end of year below 2%.
Fed cuts. So the Fed is signaling cuts for next year. The bond market's pricing in 4 to 5. The equity market's pricing a little bit more. Do you think that interest rates going down, at least on the short end of the curve, the Fed funds rate coming down, will reignite a resurgence in the money supply and reignite inflation?
Well, the answer is a kind of a qualified no on all of those things. The Fed is, and the markets are talking about the interest rates. The only thing that counts is what's going on with the money supply. So it depends on what they do really with quantitative tightening, point number one, and also banks, because banks, commercial banks, remember, are a huge contributor to the money supply. And right now, credit is contracting. Bank credit is actually contracting, along with the shrinkage of the Fed's balance sheet with quantitative tightening. And that double whammy is what's giving you this huge contraction. The commercial bank contraction in credit's about 1% on a year-over-year basis. So if they continue to want to over-regulate banks, put new regulations, new capital requirements, and all of this garbage coming out of Washington, D.C., so they understand nothing about money or banking, but that doesn't seem to stop them. They continually want to strangle the banks. And by doing that, of course, they strangle bank credit. They strangle the contribution of banks to the money supply. And with quantitative tightening, you got this double whammy going on. So I say it's all kind of qualified. Your question, you got to slice and dice the thing. But right now, it looks like they will continue with quantitative tightening, which means a reduction in the Fed's contribution to the money supply, and they will continue with tightening bank regulations, and that'll be a negative. And the only thing they're talking about is what's going on with the Fed funds rate. Well, monetary policy is not about interest rates. Most people do not understand this. It's all about what's going on with the money supply. It's not about the interest rate. So it looks like, by the way, the Fed's talking one way, like they're loosening up. The markets reacted very positively to that. But it doesn't look like those interest rate cuts, a Fed funds rate. If you look at the Fed funds futures market, it looks like they're pricing in sometime after the first quarter of the year.
Yes, March. I think you hit the nail on the head. That's the key. What are they going to do with the money supply? But Professor, correct me if I'm wrong, but isn't it typical of the central bank to ease monetary policy while also lowering rates? I mean, why would they tighten policy at the same time
Oh,
as loosening rates?
it varies. It isn't typical. You said it was typical. It's not typical. It's all over the map. They're not looking at the money supply, period. So if you're not looking at it, and Chairman Powell has adamantly said many times that the money supply doesn't have anything to do with economic activity or inflation. Utter nonsense. We've talked about this since since at least February of 2001 or maybe February of 2022. I can't remember right now. At any rate, they're not looking at it. They don't think it's important. They're ignoring it. The only thing they're looking at is the interest rates. And by the way, I can paraphrase, I can't quote exactly Milton Friedman, what he had to say about that. And that is, money supply is not about interest rates. It's about changes in the money supply. And that is also an echo of Hanke. Not only Friedman, but Hanke are in that bag. You got to watch the money supply. The Fed is not doing it. So I've used this phrase before. The Fed is kind of, would you have confidence in flying in an airplane where nothing was on the altimeter? If you were in a monetary airplane, the only thing important to be on the altimeter is the money supply. But the Fed is flying you with Chairman Powell, and he has nothing. It's blank.
The Fed has decided to use other instruments to gauge the direction and altitude of the airplane.
Right.
So to speak.
And what they're doing, it's called data. They call it data dependency. They're looking at lots of data that are all wrapped up in what's called the financial conditions indices. And these financial condition indices, which by the way were something hatched by Goldman Sachs, and the markets look at this kind of stuff. So this is the shape of the yield curve, swap rates, level of interest rates, the 10-year, exchange rates, all kinds of things are in the financial conditions index. And the problem with that is that those things move around in the financial conditions index. And the reason they move around is because a year ago, or maybe 2 years ago, something happened to the money supply. The money supply in prior times, changes in the money supply, cause those financial conditions to move around. So they're huge lagging indicators that have you way off base if that's what you're looking at. And that's what the Fed looks at. And the market, all these youngsters on Wall Street look at this stuff too. And of course are faked out all the time because they're really clueless. I've got to say, they're just clueless.
I understand. Well, you've talked about the quantitative theory of money several times on my show, Professor. And so I understand why you think there's going to be a recession next year because of the shrinkage of the money supply. But you're also saying that the inflation rate is going to stay relatively low because of that. Doesn't low inflation portend higher spending, consumer spending, and so therefore a renewed interest or activity in economic growth? In other words, doesn't low inflation mean more economic growth, not less?
Not necessarily.
No? Okay.
Because what it means is technically that the money supply comes down, and what comes down as a result of that? Nominal GDP. And nominal GDP has two components. One is inflation, and the other is real growth. And you're talking about spending and real growth, and you have to look at nominal GDP, the price inflation aspect, and the real economic growth, both of them. And you can have a situation where prices are coming. First of all, we know that nominal GDP, that is the CPI plus real growth, will come down. Okay, and that means total total spending in nominal terms will come down, because that is what nominal GDP actually is. It's nominal spending is nominal GDP. So that will come down. The inflation will come down below 2%. And given the past behavior of the money supply, we will have a recession. I just went through, David. You're not listening. You're not listening here very carefully. We've had 4 episodes of monetary contractions in the United States prior to this current one we're in. And what happened in each one of those 4? Recession. We're going to have a recession. It's just like night following day. I mean, every time it happens.
You said that we could potentially get deflation by 2025. Let's talk about that a little bit more. When you say deflation, are you talking about consumer prices or asset prices?
I'm talking about consumer prices. Headline CPI, and that has to be qualified. We're very certain about the end of year 2024 inflation forecast being somewhere below 2%, because that's already been determined by what's happened in the money supply this year. This contraction. Now, if that contraction continues for a while longer, then we will probably see some CPI numbers that are negative in 2025. But remember, I said if they keep this quantitative tightening going, let's say they keep going with this thing for another 6 months or something like that, then we will have a deflation picture in 2025.
I just can't help but notice that every time we've had deflation in our economy, something really bad happens. In fact, the last time we've had deflation for any sustained period of time was in 2008. There was a financial crisis there. I'm not saying there's going to be a financial crisis necessarily, but it just occurs to me that that's what needs to happen for deflation.
Deflation. You can have good or bad deflation. In the latter part of the 19th century, we had good deflation. We had the prices going down, being in negative territory, but real economic growth, that component of nominal GDP was very strong. That was the latter part of the 19th century. And the reason for this, we had big productivity increases and everything was fine. Now, bad deflation is what they call debt deflation, is a problem if you're over leveraged. See what I mean? If you try to, that's why right now it's a little bit tricky in China, because China actually the last monthly number is deflationary. It's a negative CPI, and China is over leveraged. Their problem in the real estate sector, for example, is over leverage. To adjust, they will have to deleverage, and that takes a long time, but it's harder to do if you're in a deflationary environment. So right now, China should increase the money supply a little bit. Right now, it should be increased by about 2 percentage points over where they're going, and they'll get the thing back on track. So for China, the formula should be a little more rapid growth in the money supply. It's not too bad, but a little higher rate of growth in the money supply to hit Hanke's golden growth rate for the money supply in China, which would be consistent with China hitting a 3%, its 3% inflation target. And then they have policies that do facilitate and accommodate deleveraging, which will take a long time, by the way. You don't do this by flipping a switch to deleverage. It takes a long time to adjust the balance sheet and get the leverage out of the balance sheets. So, by the way, speaking of the quantity theory of money, just to give the quantity theory and Milton Friedman a little shout out here, as well as my colleague John Greenwood, we've used this, and one point that you failed to emphasize is we hit the bullseye. It works. So all these people scratching their head and wondering, oh, or poo-pooing the quantity theory of money or monetarism, they're out to lunch because we have used it. It works. The proof of the pudding is in the eating, David, and it's pretty good.
The Federal Reserve isn't using this. What would you say to Jerome Powell right now if he were in your class?
The end of the semester is approaching, Chairman Powell, and I'm really saddened to inform you that your grade is going to be below the waterline.
All right. We're going to get a recession next year. I think for the average consumer watching this, and
he would say, oh, professor, I think maybe I should change my course from a letter grade to pass fail. And in that case, I would say, Chairman, I'm afraid that pass fail won't even save you.
Okay, his understanding of monetary theory aside, how would you rate the Fed's performance in bringing down inflation? I think a reporter asked a fair question earlier in the summer, which is that the energy prices have been coming down, and that may have contributed to lower inflation, much without the Fed's involvement in the energy market. So how would you rate the Fed's performance just on letter grade, bringing down inflation? Yeah.
I rate it as terrible.
Really?
I'd rate it terrible because they gave us this inflation, and now they have not brought the money supply down to Hanke's golden growth rate of 6%, which is consistent with them hitting an inflation target of 2%. So they've way overdone the thing, and they came way late, and they caused it in the first place. It's F all across the board. And whoever this clown is that says that the petroleum price is coming down is the cause of the thing coming down. This is a non-monetary reason for giving a cause of inflation movement, which is incorrect.
We haven't discussed. Sorry, please.
At any rate, I see that every day. I read the Wall Street Journal, and the reporters in there are always on all these they're giving every non-monetary reason under the sun. Now you forgot one of the Wall Street big reports this week early said, fortunately, inflation's coming down. And you know why? Because we finally gotten around to fixing the supply chain problems that were causing the inflation, and the oil prices have finally backed off and are down just a tad above $70 a barrel from being over $100 a barrel. That's what is reported. That's what the data dependent crowd looks at and reports. It has nothing to do with inflation. Inflation is a monetary phenomenon, always caused by changes in the money supply.
I think people are just looking at correlations and not the root causations.
Exactly.
Okay.
That's exactly what's going on.
We haven't talked about rate cuts themselves. First of all, do you believe that the Fed is done cutting rates? Hiking rates, rather. Do you believe that they're done hiking rates and rate cuts will follow soon?
I do believe I believe what I see in the Fed funds futures market at the Chicago Mercantile Exchange. And that market, those are objective probabilities, objective prices, and that market says that they're done. And it suggests that probably the earliest they would start, and this isn't certain, by the way, they're giving it like a 50-50 chance, is in March, the March meeting of the Fed Open Market Committee. So that's what the markets are saying. So that the markets are good enough. Markets are always good enough for Hanke.
Does the quantity theory of money make any predictions on how many cuts we can get?
No.
Okay. Those are market dependent variables. Okay, fair enough. So ultimately the consumer wants to know whether or not.
By the way, it does suggest one thing though. The quantity theory of money, with this unprecedented contraction going on, that we're going to be in so much soup in 2024 that the Fed will pivot, and we do know the history of the Fed, and when they pivot big.
What do you mean by big? They mean like 50 basis points at a time?
They'll do you know what? I can't repeat it on your program.
Okay, but to describe what they'll do, like in practical terms, they're gonna cut by like 100 basis points, 150.
Well, maybe more than 3, or maybe instead of doing 25 at a time, maybe they'll pop with a 50.
Right. Well, you're right, because historically during a recession they cut by 500 basis points. So if you're right that there's going to be a recession,
I think there. Let's put it this way: given the quantity theory of money and what Greenwood and I think lies ahead, the storm that lies ahead, the Fed is sleepwalking into a tornado, and when they hit that thing, they'll hit the panic button. And for them, what's the panic button? Well, one panic button is the Fed funds, because they watch the interest rate. The other thing is that they will terminate quantitative tightening pretty fast, because remember, no one's been talking. They're talking about the interest rate, the Fed funds. What are they going to do with the Fed funds and the pivoting and all this stuff? They aren't talking about quantitative tightening. People forget quantitative tightening is still on the books.
I just want to know at what point the Fed will realize we're in a recession, because listen to this. This is what Powell said in the newsroom yesterday. He said recent indicators suggest that growth in economic activity has slowed substantially from the outsized pace seen in the third quarter. He said, even so, GDP is on track to expand around 2.5% for the year as a whole. He goes on to say that officials see GDP at 1.4% in 2024. I mean, that growth number is a little bit lower, but it's still positive territory. A recession usually means negative growth. So he doesn't see a recession next year. Like you said, perhaps they're sleepwalking. I just want to know, at what point do they realize that we're in a recession? What indicators they would look at, because they won't cut rates dramatically unless they see a recession, correct?
Okay. I think you got to keep your eye on what's going on in the labor market. And that's a big lagging indicator. And that simply means you put your finger on the question. You said, at what point will they? At what point? They're looking at a lagging indicator suggesting that point will be too late. And it'll have something to do with what's going on in the labor market. Not only unemployment, but labor market participation, all the indicators that are tangled up with the labor market. They'll be looking at what they can consider to be the health and strength of the labor market. And when they see that deteriorating and make that determination, that is when they'll throw the switch on. But it will come too late. Because the labor market, what's going on in the labor market is a very lagging indicator. We've talked about this before, David, and the intuition is this. In the labor market, let's say you're running a business. Well, you are running a business. I'm not saying you are running a business. So would you, in your business, you have to train people. You have to get people's loyalty. You have to get them in sync and so forth. So the last thing you want to do is cut back the hours they're working, or God only knows, fire them. You don't want to fire. You never want to fire labor, because you've got a huge amount of human capital invested in them. So the last thing you do is let them go. And that's why the labor market is a lagging indicator. The first thing you start doing is, okay, you say, look, you've been involved in a lot of overtime. I'm just, demand's weak, sales are weak. I'm going to have to cut back that overtime on you. And then the next thing you would do is cut back a little bit on their regular hours. And then, God forbid, you have to throw in the towel and fire them. That would be the last thing you'd want to do. with good employees. I mean, people have the wrong idea about labor and capital and labor and capitalists. Capitalists love labor because once you mix labor and capital together, you get what? You get profit.
Okay.
So
well,
you
you also
the idea. Let's just, as long as I'm on this point,
yeah.
this is all propaganda about the capitalists are the bad guys. What do capitalists want to do? Capitalists want to take good care of their customers. Now that's fairly obvious because you want to sell things to your customers, keep them happy. But you also, you want to keep your labor supply happy because of what I just said. Now, a machine, of course, is kind of quiet. You do want to keep it oiled up and in good shape and keep the software around it running properly and everything. So everything is coordinated. You want to keep everything happy, everything smooth. You don't want problems.
You also said to me before that an employer usually doesn't cut staff or is forced to cut staff or fire people unless we're already in a recession, right? Because I'm not gonna guess. Maybe next year we'll be in a recession and start laying off people now while things are still going well for my business now. I'm gonna wait till things are really bad before I cut staff. So surely there's some other signs I should be looking for as a business owner that could point to me, gosh, things are slowing down. I should probably look into,
Well, it depends on the particular business. But as far as the recession goes, all I can tell business people is we're going to have one in next year. So factor that into your game plan. Whatever your particular game plan is, factor in the fact that we're going to have a recession.
Okay. Excellent. Well, that covers everything I wanted to ask you about the U.S. Let's shift gears now to Argentina. We just spoke about Argentina last month, right before the election. Just walk us through what's happening right now. You're an expert on dollarization. Javier Milei, just to recap for the audience, Javier Milei, conservative candidate, won the presidential election. He's a proponent of dollarizing the economy, which is to say they're going to abandon the peso eventually and just use the U.S. dollar. Since that happened a month ago, the Argentinian peso has devalued. I'll just read a tweet that you've posted a couple of days ago, yesterday, actually, just yesterday on the 13th. You said Argentina has officially devalued the peso, moving it from 391 pesos to the dollar to 800 pesos to the dollar, closer to the black market rate of 1,020. But the key question remains unanswered. What does Milei's economy minister plan to do next? Before we answer that question, let's just talk about what happened. Why is the peso devalued all of a sudden? I thought the whole point of dollarizing was to not have further devaluations in their currency.
Oh no, the whole point of dollarization is to get rid of the junk currency and replace it with the dollar. But the devalue. Let's go through some.
But if they devalue, isn't technically the inflation now even higher? Now people are suffering more.
That's the official. That's the official. Okay. That's the official exchange rate. The unofficial, which of course most people have to deal with, is what the black market rate is, what they call a blue rate in Buenos Aires, but it's a black market. So we had this huge gap between the official, artificially strong peso and the black market rate, and we had what we call this huge black market premium of, was about 700%. So if for some reason you could get the official rate and be able to buy dollars cheap, you could turn around and sell those dollars at a massive profit of 750% in a matter of 1 minute. But of course, no one can get very, very few people can get the official rate.
Well, how does that work? You can't go to a bank and just exchange with the official rate?
No, because they've got a plethora of exchange controls.
Okay.
So the official rate is in a way kind of a fiction, because they've got capital controls around the thing. You can't freely, it's not freely convertible at 350 or 391 was the rate right when I did that tweet, right before they did that tweet. The idea that's real is a fiction. You can't, because of exchange controls, get it. You can freely get the black market rate though, and that's the thing that drives inflation, and that drives what's going on in the economy. But let's back up. Let's back up just a minute. Let me take you a little trip down memory lane, David. And we had an election, and Javier Milei won, and he won because one plank in his platform was that he was going to mothball the central bank and the peso, put them in museums, and adopt the US dollar. In other words, officially dollarize the economy. That's why he won. That was what everybody wanted, because they know that will kill inflation, and it will end currency crises once and for all in Argentina, which, by the way, for the last 150 years, they have a currency crisis on average about every 15 years. That means when the currency just gets completely clobbered and wiped out its value. So that's what the public wanted. He won the election, and now he appears to have kind of changed course. And although he says that dollarization is non-negotiable, he now has the sequence of things all wrong, in my view. The sequence, to be correct, should be you do the dollarization first. That's the first thing you do. That gives you credibility and gives the economy stability, because you kill inflation. And then with that stability underneath you, you can clean the stables and start fixing the fiscal house, the regulations in the economy, the exchange, all of the things that have to be fixed. He has appointed a finance minister who actually is opposed to dollarization. And he thinks you can clean the stables first, and then sometime in the distant future dollarize the economy. It's never going to happen. They'll never be able to clean the stables.
Maybe they realize they don't have enough reserves to dollarize. Is that possible?
Well, they do. This is another thing that Milei has been poorly advised on. That they claim they don't have enough reserves. They do. They have enough gross reserves at the central bank to do the only conversion required, and that is the peso banknotes that are outstanding. Those have to be converted into US dollar notes. But everything else, all the assets and liabilities, not only at the central bank, but also in the economy, with the stroke of a pen, you redenominate all of them into US dollars. And the only thing you need is, well, what's the conversion rate going to be? What's the rate going to be? And I have recommended that to figure out the rate, they should announce they're going to dollarize. They should freeze the peso monetary base, print no new pesos, let the peso float against the dollar freely without any restrictions for 30 days. And at the end of that 30-day period, come up with a determination of what the conversion rate, what the fair value of the peso in the market is, and what the conversion rate between dollars and pesos should be. And that is the rate that should be used. That's exactly what I did in Bulgaria, by the way, in 1997. We froze the monetary base of the Bulgarian lev. We let it float against all currencies. We determined what the rate was for fair value between the lev and the German mark at the time. And we used that rate to do the conversion that established the currency board. We didn't dollarize. We established a currency board, but that's how we determined the fair value. And that's the way I think they should do it in Argentina. And if they did it, by the way, I think the fair value would be something, I think it would probably be a little less than 800. The official rate now is 800. The black market rate's a little over 1,000. I think if they let it float freely, it would come in maybe around 600, 650, something like that, in that zone. But at any rate, whatever the fair value is, they have enough reserves. This is just a phony argument by people who don't understand how you dollarize and what has to be dollarized.
Maybe I'm just speculating. I don't know as much as you, obviously, but maybe they're doing this as a first step towards dollarization. Maybe they got the order wrong, but by devaluing the peso, they could get more pesos per dollar if they were to dollarize. Right, it's a better deal for the central bank.
Well, I think I think they're just trying to line up and get the official rate more in line with what's clearly the free market, black market rate, and trying to get rid of the multiple exchange rate system that they had, where they actually had 8 exchange rates, not one. We're talking about one, but they had 8, and now they're trying to unify it down to get rid of the multiple exchange rates and get the official rate more in line with the black market rate. So I don't think it has anything to do really with them being smart enough to figure out what to do for the conversion rate and so forth.
Okay, okay. And just to clarify, simply devaluing the peso in itself is not going to fix inflation, right?
No,
Okay.
it has nothing to do with it.
Right. Okay. So let's answer the question that you posed yourself. What is the new Minister of Finance going to do next?
I don't know.
See,
No one knows what he has up his sleeve. He's comes from a trading background.
right.
He's a trader, and traders, their time horizon is about 24 hours.
Well, we know what you would do. You've just outlined it for us, but it is interesting how Milei hired somebody who is opposed to dollarization. Maybe his game plan is to come to a middle ground, because we know half the country doesn't want this, right? So, or
Well,
marginally more than half the country wants
that's
this.
true. What happened is that Caputo, which is he's the new finance minister, he or economy minister as they call it down there. But anyway, Caputo, he's a Macri, former President Macri man. So what's going on here politically? It doesn't take a rocket scientist to figure it out. Before the final election, Javier Milei needed support, and he needed the conservatives who he'd been running against. He needed them in a coalition. He needed all the Macri people in the center in his coalition. And part of the deal he struck, maybe it was a deal with the devil with Macri, because he's got all these Macri people, and those people have tended to be opposed to dollarization, and they tend to be what's called gradualists. Remember, Macri was a gradualist. He was going to reform things gradually. Well, that didn't work very well. It blew up. It was a complete disaster. He lost the election. It was thrown out. And the gradualist people were zeros. They were out. And now Milei seems to have struck a deal with them to get the political votes he needed to win the election. He has these technical people who are fundamentally gradualists. Well, he's not. Milei isn't. He said he wasn't a gradualist. He was supposedly a radical, a big banger. Well, now it looks like the Big Bang is going to be a little pop gun affair, in which they go in and they try to do this cleaning of the stables business gradually first, and eventually do the Big Bang. And what is the Big Bang? There's only one Big Bang, and that's dollarization. And there's only one thing they must do to get credible and to stabilize the economy, and that's dollarization. So that's why Hanke says they've got the sequence of the thing all screwed up. And that's why I think there's a high risk that the whole thing will come apart.
Is there any chance of them to stabilize inflation at this point?
No.
All right, so it's done.
I wrote on read my October 25, 1991. We're going back over 30 years. October 25, 1991, Wall Street Journal. Argentina should get rid of its central bank. Author, Professor Steve H. Hanke. I was President Carlos Menem's advisor at the time. That's over 30 years ago. If they would have done that 30 years ago, they'd be in heaven right now. Leaving the central bank in place is the equivalent of putting a bottle of whiskey next to a struggling alcoholic.
Okay, just to end on this note, Professor, can you give us one historical precedent, one or two, in which a country has successfully dollarized and then prospered afterward?
Yeah, all of them. Do I have to go through all of them? And they're right now they're 33, but in Latin America we've got Panama. It's been dollarized for over a century. We've got El Salvador, which was dollarized in 2021, and from 2021 to 2023 had the lowest inflation rate in South America, even lower than the United States. It was 2% over that 23-year period. Ecuador, very successful. They poo-poo Ecuador. I was involved as an advisor to the Minister of Economy in 2000 and 2001 when they dollarized. And they've been relatively successful, even though they had a very left-wing president, Rafael Correa, for 2 terms. So those are the Latin American ones. How about Liechtenstein? Liechtenstein's dollarized, very successful. How about Montenegro? I dollarized Montenegro in 1999. We got rid of the hyperinflating Yugoslav dinar and replaced it with the German mark. Now they use the euro, and they're in line to be in NATO and in the EU.
Hypothetical question, I'll end it here. If a country were to, let's say most citizens of this country, let's use Argentina, for example. Suppose most Argentinians don't use the dollar for their everyday life. They use, I don't know, the Chinese yuan or something else, or the euro or Bitcoin. Should a country then just adopt whatever it is that the people are using already? I mean, do they need to use a US dollar in particular?
But yeah. If that, absolutely. If that's the majority, because that's consumer sovereignty. Individuals privately have voted with their wallet. And if they don't like the local currency and they've gone into the Chinese yuan or euro or whatever, gold or whatever it happens to Bitcoin, so be it. That's what they want. They've already indicated privately that that's what they want. In Argentina, of course, it's big time US dollar and always has been. They've got 265 billion in US dollar notes stashed away under the mattress in safety deposit boxes. That's the biggest stash of US dollar notes that's outside the continental United States. It's in Argentina. That's where all the dollars are. By the way, that's very good business for the US government because
that's exactly what I was gonna, yeah.
It costs almost nothing to print a note. And the US dollar, the US government does that, and to get those US dollar notes, you have to give somebody in the US a dollar.
I was just gonna, you read my mind. I was just gonna ask you, and we'll wrap up here, Professor. I was just gonna ask you if it benefits the US government in any way politically and or economically for a country to dollarize.
Well, I'd say the big benefit is for the country that dollarizes, and by the way, and that should keep them on very good terms with the United States. So I always think having Having more friends is better than having more enemies, and having friends that have strong economies and stable economies is great. If you had all of Latin America dollarized, like I recommended over 30 years ago, we would have zero problem at the southern border. Why do you think Venezuela has been emptied of 25% of its population? Because under Maduro's left-wing government, they've had 2 hyperinflations in the last 10 years. That's why everyone with these currency problems, they become impoverished. They try to run away from it. That's why we've got, if you watch the news, or at least watch Fox News, most of the news censor this and don't show it, but Fox shows pictures of what's going on in the border every night, and you've got a stream of South Americans and now Africans. They're from all over the place, but lots of Latinos, big time, and by the way, even Chinese.
Right. Okay. Are you surprised that other competing powers like China isn't actively soliciting other countries to use their currency?
Well, China is big time. China has a. Remember, I'm on the advisory board of Renmin University in Beijing, and one of our main tasks, shall we say, our mandates is how to make the yuan convertible and make it more usable internationally. Well, so Beijing is very, very interested in spreading the use of the yuan. And the big handicap they have, by the way, is the fact that it's not freely convertible.
Right. Yeah. I mean, they do, expand their spheres of influence that way. Well, excellent. Thank you very much, Professor. Where can we follow you and learn from you? And
well, I think the easiest thing is to follow me on Twitter. It's at Steve_Hanke. You can maybe put that up on your screen. And by the way, if people actually want to get on my regular mailing list and distribution list, they can write me at Hanke@jhu.edu. Just send me an email and I'll put you on the list.
All right. Well, we'll put the links in the description down below, so feel free to reach out to Professor Hanke directly. Well, thank you very much. If I don't see you before Christmas, Merry Christmas, Happy Holidays, and thank you so much.
Merry Christmas to you, David. Great to be with you. I do have one observation before Christmas. Your mother has let you grow your hair a little longer.
I've evicted my mother from her responsibilities of dictating my hairstyle, so she no longer has a say.
I assume she still has plenty of influence over you.
Not, yes, you're right, but not in the hair department. But thank you for noticing.
Okay, great.
I appreciate you being on the show as always. Thank you for your contributions this year, and I'll see you, if not before the end of the year, then next year for sure. Thank you very much.
Great. See you, David. Thanks.
Thank you. Bye-bye.